This is more than just a channel. This is legacy, where wisdom meets purpose intentionally. From life tips to generational wealth, we're building you up, buying home and head. From granny's voice to your next big move, every lesson here is built to improve. From buying homes to healing your soul, we're passing down what makes you whole. Next gen rise and it's time to grow. We're the voice you need to know, where every generation plays a role, helping you become your greatest goal.
Hello, you're on, sir.
Good evening, good evening, good evening. Thank you for joining us. Hope your week is going well. Hope everything's going good so far. Thank you for joining us on this home buying process. My name is Damon Holland, Holland Homes team. You already know me. And like I said, today we're going to talk about home purchase process, roadmap for success of home ownership. I'm also joined today by Jennifer Spigner from Tabor Mortgage. She's going to answer all of your financial questions, anything financial dealing with money. She has you definitely. She can answer all your questions. Also, before we get started, I want to thank Dana with the Next Gen team. She is the host for today. So anything as far as questions, she's going to monitor any of that, and we'll answer all your questions as we go along. So we are here for a short time and a good time. So let's jump right into it. Next slide. This is the overview of home buying processes, everything we're going to hit today. And probably a little bit more stuff too. We're actually going to get into a lot more stuff. Accessing home readiness, securing mortgage pre-approval, identifying homes and needs and preferences, real estate agent, that should be number one. We might need to change that for later. But searching for homes, making an offer, completing a home inspection and appraisal, final mortgage process, reviewing closing documents, and finally getting them keys and moving in. Next slide. Financial readiness. We're going to start out with Jennifer. And like I said, she's going to talk about anything as far as finance and also preparing and getting ready to purchase a home. So Jennifer, it's all you.
Hey everyone, hope everyone is doing well tonight. Thank you for coming on. So I am your mortgage lender tonight. My name is Jennifer Spigner from Charleston, South Carolina, and I am assessing your financial readiness. So let's get started. Okay, you can move to the, okay. So the first thing you want to look into when you're trying to purchase a home is you want to look at your budget, your savings, essentially what your cash looking like, because that's very, very important. I like to say that cash is king, because cash pretty much rules the world. As long as you got money in your pocket, you can make some things happen, even as far as purchasing a home. So as you're looking at the template in front of you, the slide in front of you is kind of giving you some insight as far as housing cost guidelines and down payment and reserves and tracking finances. I know you can read, but in a nutshell, what it's all about is you want to basically create a budget. You know how much you get paid every month. You know all of the debts or expenses that you have every month as well. So you want to make sure that things are falling into place, because what you do to get the house, you have to continue that even after you get the house, so you don't go into foreclosure or come up with any issues. So basically having a budget and having a savings account, knowing how to save. My grandmother just told me today that her father, which was my great grandfather, used to say, hey, if you make $10, save $1. Don't spend all your money at one time. So that principle applies to everything in life, but definitely when you're purchasing a home, because this is a big ticket item that you're purchasing. You're asking for hundreds of thousands of dollars. And so what the underwriters want to see, the underwriters are the people that make the decision whether they're going to allow you to buy the house using their money, is they want to make sure that you have some skin in the game. And that's what savings is all about. That's what having a budget is all about. And it also shows that you're stable. So making sure that you have a budget, or if you already have a budget, tweak it or fine tune it if you need to, so that it makes sense for you, so that you're able to save. Like the little picture there says, saving for a vacation, saving for savings, emergency funds, all of that makes sense. Saving to purchase a home, definitely a plus. So this is all about budgeting and saving. So we can move to the next one. All right, now, just like I said, cash is king, credit is queen. So not only do you need the cash, you need the credit. Why is credit so important? Credit is important because credit tells you, well, it shows me what type of person you are. I can look at somebody's credit report and tell what type of person they are. What I mean when I say that is that, are you a person that handles your business? Do you pay your bills? Do you pay your bills on time? And so that's what the underwriter, that's what the loan officer, the lender, that's what they're looking for. They're looking to see your credit health, your credit worthiness. They're looking to see, how you handle finances in a nutshell. Not only are we looking at your credit score, because your credit score is going to tell us what type of loan program you can get into, whether it is an FHA or a conventional or VA or USDA, all those loan product programs that we have. But it's the credit history that really plays ball as well, because not only are we looking at your score, we're looking at over time, what were you doing? When you got that car payment, was you paying your car payment on time, or did you have some issues in a few months where you couldn't pay it on time? Or if you got that credit card, do you have a very high utilization? Do you know how to use a credit card? And believe me, folks, this is not stuff that we learn in high school and in college. Unfortunately, a lot of times people have to figure it out on their own by trial and error. But I'm here to help you tonight, or your local lender is here to help you in the future about what it means to have good credit and how to strengthen your credit if your credit needs to be strengthened. Of course, like I said, the credit score determines what type of loan program you can get, but your credit score also tells you the strength of your credit history. So of course, the higher your credit score, the better it shows you, or better it shows the underwriter or the person that's making the decision to give you the loan, is showing them that you know how to handle your credit cards. You know how to take care of paying your loans and different things like that. But do you need to have a 700 or 800 credit score to purchase a house? Absolutely not. If you did an FHA loan, which is a government loan, all you need is a 580. I've actually closed somebody with a 525 last year. We went FHA with them, but they had to have some compensating factors, meaning because their credit was so low, being at 525, we had to also make sure they had cash and they had to have lots of it. So what am I saying in regards to credit score and credit history? It is very important. Keep in mind, credit score, credit history is queen and cash is king. You have to have both to be successful when you're trying to purchase. Next slide. And if anyone has any questions, feel free to, display that, because for some reason now I can't see anything as we go forward. I don't mind answering questions just in case someone has something specific they want to say. So this slide here is estimating home affordability. So of course, as a homeowner or looking to be a homeowner, again, that first slide we were talking about was budgeting. So this kind of entails with that, just trying to find what lane works for you. Are we looking at a house that's $300,000? Are we looking at a house that's $500,000? Are we looking at a house that's $89,000? And so there's some things that come into play. For example, the income. Your income has to be stable. You need a 2-year work history as far as income goes. So it doesn't have to be with the same job, because I get that question a lot. You know, hey, I've worked for 2 years, but I worked at Home Depot for 6 months, and then I was at Lowe's for 8 months, and then I was at Walmart for a year and a half before that. Hey, that's your 2-year work history. As long as you have a 2-year work history, it doesn't have to be at the same job. You'll be good on that. When we talk about debts, there's something that's called debt to income ratio, or DTI, debt to income ratio. What that means is exactly what it says. It's comparing your debt, what we see on your credit report, not worrying about your cell phone bill, not worrying about your Netflix account, but debt would be student loans, car payments, your if you bought furniture from your favorite furniture spot and you financed it, and now you're paying a bill on that because you financed it, that's going to probably pop up on your credit report. So any debt that is showing on your credit report is what we're looking at. And then of course the income as to what you are bringing in. And then of course there's the down payment. Down payment is basically your skin in the game. How much money you have to pay to put down in order to qualify for this loan. Every loan has a down payment minimum. FHA loans, 3.5% down. Conventional loans, 3% down if you're a first-time home buyer, 5% down if you're not. USDA, there's no down payment. So if you want to live in a house that's in a rural area that's USDA certified, you don't have to put anything down. If you're military, any veterans out there, guess what? You don't have to put anything down. The beauty of being a veteran or in the military. Thank you for your service, by the way. Somebody just asked a question, how do I know how much house I can afford? I think that was the question, correct? Okay. At Boomer Vom's mom, I see you. How do I know what I can afford? So how you determine that is essentially you're going to have to do a home application so that the lender can determine how much house you can afford. But if you kind of wanted to play with the numbers just to kind of see how that would work for you, you're basically going to do a few things. You're going to look at your income, and you're going to look at the amount of debt that you have, and you're going to compare those two. That's that debt to income ratio I was telling you about, because it's your debt to income ratio that will determine really how much house you can afford as far as sales price. Where credit comes in is just letting you know what type of loan you can get: FHA, conventional, USDA, VA. What cash comes in at is to let you know how much, if you have the money to be able to put down, pay your closing costs, pay any fees that are associated to getting a home loan. You have to do an appraisal to make sure the house appraises. So that's where the cash comes in at. Now, you can have a very low debt to income ratio, which is a good thing, because if your debt to income ratio is low, what that means is that you have low debt. If your debt to income ratio is high, that means you have high debt, which means you can't borrow as much. Because the debt to income ratio, not only does it compare your income that you bring in and comparing your debt that you have to bring out, but it's also going to add in that mortgage payment that you're going to get on the house that you want to buy. So the lower your debt to income ratio is, the better. So that's a very broad question of what you just asked, but it's a very intricate question nonetheless. And so it's not a question that I could just give you black and white. I can basically say, in order to find out how much house you can qualify, you have to compare your income to your debt, and then see what your debt to income ratio is and go from there. I'll give you an example if we want to take it a little bit further. Let's just throw out an example out there. Let's say someone makes $5,000 a month. And we know that $5,000 a month is pretty much someone that makes 60 grand. So if you're making 60 grand a year, that's about $5,000 a month. Now, that $5,000 a month sounds like some really good money for most people, right? But if you have a car payment, let's say you have a car payment and your car payment is, I don't know, $500. Okay. So now we have to deduct $500 from your $5,000, right? Then on top of that, let's say you have student loans. Well, I'm not paying student loans right now, Ms. Jen. Well, it doesn't matter, because what the underwriter wants to make sure is that if you have student loans, they have to still add a payment in there because whenever you have to start paying on it again, they want to make sure that you can still pay your student loans and your mortgage. So let's say you have $30,000, not much, $30,000 in student loans. And let's say what we could do is we're going to say that that's like $100 payment. So now we're going to have to take $100 off of that as well. So we took the $500 car payment, we took the $100 student loan payment, and let's say you have a credit card. Let's say you got 2 credit cards, and your credit cards are $250 a month. So once we subtract that from your initial income, you're now left with $4,100, $4,150 to be exact, right? So now we have to divide that by 2. Why do we divide it by 2? Because you can't use your whole check to pay a mortgage. You only can use a portion of that. So now you're left with about $2,075. So $2,075 has to basically cover your mortgage payment. And we all know that your mortgage payment is consisted of your principal and interest payment, taxes and insurance. And if you're not putting 20% down, like on a conventional loan, you're going to have something called mortgage insurance, which is basically the lender charging you money just in case you were to foreclose. They're getting something out the bag, right? If I'm going too fast, somebody tell me to slow down, because I do talk fast. So my apologies. But basically, what I was saying is you have a $60,000 yearly income. $5,000 a month is your income if we break it down into monthly payments. So that $5,000 a month is what you're bringing in. And we took away all of your debt, which was your car payment, your student loans, and 2 credit cards, right? And then we divided that by 2 because you can't use your whole check to cover a mortgage. So out of $5,000 a month in income, removing those debt, you have a $2,000 mortgage payment that you can basically afford. Well, what does that $2,000 really mean? $2,000 in Charleston, I'm just going to say Charleston, South Carolina, because that's where I am. $2,000 in Charleston is pretty much going to give you about a $300,000 house with maybe 5 to 6% interest. We're not going to worry about HOA and all that kind of stuff. Just kind of giving you a little idea. $2,000 is pretty much a $300,000 house. So you have to say to yourself, if I make less than $60,000, then I can't even get a $300,000 house. If I make more than $60,000, I might be all right. But what if I got more debt? What if my car payment is $750? What if I got 2 car payments? What if I got multiple credit cards? What if I got more debt? You see what I'm saying? Now the numbers start to make sense. If I lost anybody, please let me know you lost me. But just as to give you an example, because that question that she asked is one of the most question I get on a daily basis. So as you can see, we can get real deep into this, but just to kind of give you just a snippet of what we're dealing with as far as the numbers are concerned. I hope I answered your question. We can go to the next slide. Somebody asked the question, is it better to have low debt or no debt? That's a very loaded question, Regina. A great question too. Is it better to have low debt or no debt? I'm going to say it's going to depend, because if you have a good income, if you have a lot of income, then it's okay to have some debt. Just like that example I gave with the person who makes $60,000 a year with a monthly income of $5,000 and they just had that little bit of debt. Say somebody didn't make $50,000 and they made $40,000 a year. So now they're bringing home maybe $4,100 instead of $5,000. And if they had the same amount of debt, guess what? Now they would only be able to qualify for a mortgage payment of maybe $1,800, which would be trying to buy a house for maybe $275. Well, I'll tell you right now, if you in Charleston, that means you ain't gonna qualify for nothing. What that tells me is you're gonna need a co-borrower. And for some reason, a lot of first-time home buyers don't want a co-borrower. They say, I want to do this myself. I want to do this myself. And I value that they want to do it themselves. But because of the way the market is, not even with the interest rates, let's just take interest rates off the table, because everybody thinks it's the interest rates, but really it's the purchase of prices. These house prices are going up. They're not going down. That's excellent for people who already own their house, because there's something that's called equity. and they're getting lots of it. And that's a beautiful thing. But when you're trying to dip your baby toe in the market and buy a house, you know, that could be a little challenging for some people if they have a lot of debt or, you know, they don't make a whole lot of money. So is it better to have low debt or high debt or no debt at all? It's going to depend on your financial situation. How much money do you have? Because if you got $6,000 or $7,000 that you're making a month and your debt is low, you're going to be okay. You're going to be okay. So I would say, to answer your question, it's going to be based off of your financial situation. It's going to be based off of how much money you're bringing to the table a month. That really answers your question. Is it okay to have low debt or no debt at all? Okay. Securing mortgage pre-approval. Okay, we can start that. I love these questions. These are awesome. I hope I'm helping somebody. Okay, Dana, we can go to the next slide. Okay, perfect. All right. So understanding the types of mortgages. We pretty much got a little bit into this as I was talking. There's so many different things that goes on with mortgages and the kind of mortgages and all of that. So to not blow your head off, I'll try to be brief with this. There are different types of mortgages as far as the type of mortgage that you can get. Do you have an FHA loan? Do you have a conventional loan? Do you have a USDA loan? Do you have a VA loan? I kind of went a little bit into that earlier, where an FHA loan, a VA loan, and a USDA loan, those are all government loans, meaning that they're backed by the government in some way, shape, or form. FHA is pretty much the number one loan type that's for most first-time home buyers because the down payment is low. Your credit score could be lower and you can have a little bit more debt. What I mean when I say that is every loan program has a minimum down payment, and every loan program has a minimum credit score that you have to meet, and every loan program has a maximum debt to income ratio. Remember, we was talking about DTI just a little while ago, comparing your income to your debt. So each program has its own qualifications, stipulations, and based off of what you have is what determines what type of loan you can get. If you are a first-time home buyer, you got a 600 credit score, you got maybe $5,000 or $10,000 in the bank, your debt to income ratio is pretty high, then you might need to go FHA. Why? Because the credit score minimum is 580, you're at a 600. You don't have that much money in the bank, and you got a little bit more than a little debt. So you might need to go FHA. If you got a 720 credit score and you got $40,000 in the bank and you don't really have no debt, you might want to go conventional because your credit score is higher, you got some good money in the bank, and you don't have much debt. That's a conventional loan all day long. Okay, so those are the types of loans that we do. We also do non-QM loans too for people that are looking to invest. Let's say let's say there's someone on here that's already a homeowner and they're looking to do an investment property. We do have programs that are not traditional that we can talk to. So if there's anybody out there who is already a homeowner and they're wanting to maybe dibble and dabble into some investment property or something like that, or renovate a property that they saw, then let me know if you have any questions and I can talk about that too. In regards to interest rates, you have what we call a fixed rate for your mortgage, or you can do an ARM or an adjustable rate mortgage. Most people do a fixed rate because if I say your rate is going to be 6.5%, that's your rate for 30 years. But sometimes some people might want to jump on the adjustable rate mortgage or the ARM because maybe that ARM has a interest rate of, I don't know, 3.99, but the market is 6.5. So you might want to jump on an adjustable rate mortgage because the benefit of it is early on, you getting this crazy low rate, lower than anybody else that's buying. But the caveat is it's only going to last for a season. It's only going to last for a certain amount of time, 5 years, 7 years, what have you. And then after that time is gone, then it's going to be, oh Lord, hold on to your bootstraps, because it could jump up, it could go down, it'd be all over the place. But most people who know what they're doing, or maybe they don't know what they're doing, but they have somebody like me in their corner, I would be calling you and say, hey, it's getting close to that time where your time limit on your arm is gonna be running out. Let's go ahead and do a refinance and put you into a fixed rate. So after the 3.99 of 5 years or 7 years is done, now we can get into a fixed rate. And we can go deeper in that too. But if anybody has any questions in regarding to that, let me know. So those are the types of mortgages that I was talking about. Boomer Vaughn's mom, what is an escrow? Do I need to have it? Damien, you want to answer that?
Did you say Dana or
So
Damon?
far as
Damon.
yeah, I can jump on that one real quick too. Escrow, far as escrow, it's I got it. That ain't no problem. Escrow is an account that holds money. It'll hold your earnest money as far as when we get into the transaction and putting in contracts. Your money be held in escrow, which be held by a attorney's office, real estate closing attorney's office, and they will hold that until the contract is executed, pretty much. So that's something that will be done at the time of contract. You probably hear that all the time, money being held in escrow.
So Damon, would that be almost like once you find the house that you like, you go under contract, and to make the sellers realize that you're serious about buying the house, they may say the earnest money is $5,000. That $5,000 will go into that account that's called an escrow account. Is that
correct?
Okay.
Correct.
See, I'm learning something too. Yes, I love it. Okay,
correct.
Dana,
Yes.
we can switch over. Okay. Gathering required financial documents. This is very important because what I like to explain to my families or my clients, if you will, is when you're buying a house or a home or property, unless you're buying that property cash, you need a loan to purchase the house or the property, correct? Now, you're asking to borrow hundreds of thousands of dollars, as we said before. You can look nice. You can wear a 3-piece suit. You could wear a gown and just be on top of the world. But the underwriter and the lenders and the banks want to know one thing. Are we going to get our money back? That's it. That's the bottom line. Are they going to pay us back? Right? So you can say, I got a 700 credit score. I got $80,000 in the bank because my granddaddy left it to me after he passed. And I've been working at this government job that I've been on for 10 years. I'm solid. I'm straight. And all of that is great. But you always got to have proof in the pudding. So that means you got to have documentation for everything. We check in. You telling me you got a 800 credit score? Okay, I need to see your credit history. That means I need to run your credit. You telling me you make $10,000 a month? You making 6 figures? That's great. I need to see your pay stubs. I need to see your W-2s. I need to see your tax returns if you're self-employed or a 1099 worker. If you're telling me that you got $80,000 in the bank because you just got it from a trust fund or you just got it from someone in your family passing, awesome. I need to see the bank statements. So when we're talking about documents, we have to document everything. I actually had a client that said, man, Ms. Jen, y'all asking me for everything but the size of my underwear. I said, yeah, pretty much. because everything has to be documented. This is how the underwriters, this is how the processors, this is how the team that is going to make that decision whether they should let you borrow $350,000 to buy that home that you just saw on 3235 Hickory Street. They want to make sure that everything is legit. So they're going to ask you for pay stubs. We need 30 days worth of pay stubs. They're going to ask you for the last 2 years of W-2s. They're going to ask you for the last 2 years of tax returns if you are self-employed. They're going to ask you for a 60-day or 2-month, the last recent 2 months of your bank statements. These are the things that they're going to ask you for. They're going to ask you for your driver's license or passport or anything that shows your identification. Yes, we are going to run your credit report to see what type of credit you have going on. So that's pretty easy in a nutshell. Dana, you can switch. Obtaining a pre-approval letter. That's what it's all about, ladies and gentlemen. This is it. This is what you came here for tonight. Once we have that conversation of me introducing myself and you telling me a little bit about your goals, because I love to hear that, that lets me know which way we need to go. And once I tell you, hey, here's the application, take 15 minutes and fill this out completely and upload your pay stubs, W-2s, tax returns, bank statements, all of the above. If everything is a go, guess what? What you need to get from me is a pre-approval letter. That is what you call your golden ticket. That's your golden ticket for those who have watched Willy Wonka and the Chocolate Factory. You got the golden ticket. This is it. This makes your life easier, my life easier, and it will make your realtor life easier as well. Because nowadays, you cannot go see a house. I don't care if it's your next door neighbor house. You cannot go see a house without this golden ticket, this pre-approval letter. This letter lets you, me, and your realtor know that you have met a great deal of the requirements to at least get a pre-approval. This pre-approval is going to say, congratulations, you have just been pre-approved for $375,000 based off of all the information that you've placed on your application and based off of the documentation that you provided. So now once you get that pre-approval, you can now call Damon up and say, hey, Mr. Damon, I'm ready to go shopping. Let's make it happen. And he looks at that pre-approval and he said, okay, 375, not bad. We can make some things happen with 375. He knows what neighborhoods to take you to. He knows what zip codes to take you to. He knows a good deal of where he needs to take you based off of that pre-approval, along with the extra things that you tell him as far as, you know, I don't want an HOA, I want a big yard, you know, I don't want to be by no large body of water, all that kind of stuff. So the pre-approval is definitely what our goal is trying to get. And I believe I'm done on that. Yes, Damon is the best. I second that, Boomer.
I appreciate that. Thank you. Thank you. Jennifer, I got a quick question for you though. Can you go into this? Is something I get asked a lot of times. The difference between the pre-qualification versus the pre-approval.
Oh, absolutely. Would love to. Simple thing between the two. One, you are giving me documents. The other one, you're not. If you're getting a pre-qual, that means somebody was just on the phone and they just asked you a few questions. You gave them what you wanted to give them, and boom, you're done. I don't do those. I do pre-approvals only, because at the end of the day, when I give Damon that golden ticket, he for sure knows if I get this pre-approval from Jen, we legit, we can go look at a house. You can tell me you like this house and we putting in an offer and we going under contract, and in 30 days you getting your keys. With pre-quals, you can't do that, because now you got to kind of back up a little bit and send documents. And what if you told them you're full-time and you make $30 an hour, but then when they look at the pay stubs, you had a couple weeks where you wasn't making 40 hours a week, you was making 32. So that $375,000 pre-approval you thought you had would look more like 350. I guess we're in a little bit of trouble now, Damon, wouldn't we? Because we can't buy that house because your documents didn't show what you said you had when you was on the phone. So pre-approvals work out better because you're kind of doing a lot of the harder work up front by giving those documents. Pre-approval is the way to go.
Absolutely. All good information, perfect information. And just like Jennifer said, that pre-approval is even when I'm sitting down with clients and when I'm talking, some of my first questions are, do you have a pre-approval letter? Have you talked to a loan officer yet? Those are some of my first questions because those are things that I need in the beginning. So appreciate that. We're probably gonna get into a little bit more finance as we go through the slides, but like I said, all great information and everything that I need to get everything started. So selecting ideal locations for neighborhoods. This is definitely one of important as far as research. I tell clients all the time, research your area, know where you want to be as far as schools, neighborhoods, market trends, different planning like that. I also tell them, try to go drive through the neighborhood sometimes at different times too. Go through the neighborhood in the afternoon, go in the morning doing traffic, rush hour times, if you know, as far as location, as far as jobs and different things like that. But travel that neighborhood different times and get a feel for it first. Safety factors that can like that too. So that's just one of the things that helped me as far as the search also. Next slide. And again, if you have any questions, please put your question up. Definitely like the interaction, get everything answered as we go along. Property type, single family home, condo, townhome. That's something you definitely need to discuss and think about beforehand. All that is important as far as the search that I'm gonna set you up on. First time home buyers, sometimes they want to go smaller just because they're starting out. Sometimes they don't. It just all depends. Considering growth, that's definitely something to think about. Whether you're getting ready to start a family, you already have a family, you may want to start out 1 or 2 bedrooms and then grow from there. Right now, the average, as far as moving, for the national average, everybody moves between every 5 to 7 years. So that's something to think about also. Next slide. Real estate agent, like I said, this should be number 1, but we're going to keep it going right here. Next slide. With this, interview different agents. The key to this is, I always say, is find somebody that you're comfortable working with. This is most people's biggest purchase that they're making in their life. So definitely find somebody you trust, know, like, and trust. That's 3 things I always bring up, and that you're comfortable working with. Next slide. As far as me, my main roles is I'm an advisor. I facilitate the process. I am not the final decision maker. You as the client are the final decision maker. My job is to put all of your opportunities on the table according to the market. Translate the market also, but put all your options on the table, and then you choose what's best for you and your family and your situation. Transaction coordinator, I'm definitely, again, like I said, I facilitate the entire process myself along with Jennifer. So I definitely include her. Once you choose a home or choose a neighborhood, I'm going to send it over to Jennifer so she can look at it and do some research on her side. And collectively, we are all on your team during the process. That's that buyer collaboration I was talking about also. So we are all on that team and getting you down the road to home ownership. Jennifer, real quick, can you tap on the overall entire process and kind of hit on the importance of being in that process the entire time and not creating more debt once you get that pre-approval? Because I've seen that before too.
Yeah, that's actually one of the interesting things that happens a lot, as far as just making sure that once you get that pre-approval. I always tell people, okay, you got your golden ticket. Your job is to work with Damon to find your house, but keep doing what you've been doing. Keep going to work, keep showing up, keep paying your bills. I usually tell people once I run that your credit, don't have anybody else running your credit. Don't try to get no credit card or go buy furniture. Do all of that after you get your keys. You just want to keep life simple and keep doing what you were doing before you came to us that allowed you to get pre-approved in the first place. So don't make any major changes. Don't even try to go switch jobs. If you feel like you were kind of already in the process to switch your job, come talk with me so that we can kind of see what that's going to look like or how that's going to affect or not affect, the overall process. Does that kind of answer your question?
Yes, absolutely. Absolutely. So the most important thing we're trying to stress here is this road to home ownership. It starts with that getting that pre-approval. Once you decide to make that decision that, yes, I want to buy a home, talking with Jennifer, getting that pre-approval all the way until you get your keys. And we got a question from Regina. Pick a risk, can I find if she's not a good fit? Can I switch? Yes, you can. Yes, you can. The contract can be canceled. Yes, the contract can be canceled. Another one of the first questions I ask, are you under contract with another realtor? So that is a possibility, and you can switch out. You can pretty much cancel that contract and go with somebody else. Next slide. Searching for homes. Next slide. A lot of different ways we're going to do this. We're going to do this online. We're going to do this by open houses, different neighborhoods. We're also going to combine new homes community too. So all of this goes into the exploring online and offline searches. Next slide. First-hand evaluation, these are the showings. I always tell the clients, pictures will bring you in, but we definitely need to go see and walk around the house and see how it feels, walk around the neighborhood, the outside, the neighbors, just to get a feel also. I have had a few clients choose a home solely off of pictures. That's because they was coming from out of town. It still worked out, but I always suggest a viewing, a showing, going to see the property and making sure it's the right fit for you and your family. Next slide. Narrowing down choices. I always try to have a top 5 with a rolling 3. Reason why I say rolling top 3, we'll pick out those top 3 properties. And as you know, the market constantly changes. So we may be viewing that first property, your first choice, and your third choice may go under contract. It happens all the time. I've seen it a lot. So when that third one goes under contract and is now off the market, you can just bring up the next one in the queue. So it's kind of a rolling, like I said, rolling 3, rolling 5. Also with that, I always say kind of after the 10th house, it kind of you kind of start forgetting what you looked at in the first place, in the first house. That's why we kind of want to stick with a top 5 that you like. Next slide. Making an offer. Next slide. Now, I'm not going to get too into detail as far as making an offer, but there are some main parts of making an offer. We're talking about closing costs. We're talking about earnest money. We're talking about contingencies, which consist of inspection process, appraisal, CL 100, which is a termite inspection. Everything on that offer, when we're submitting the offer, is negotiable. And all of this depends on what that seller, when you send it over to the seller, what they're looking at and what they see, and how to create a stronger offer. Like I said, I can pretty much go into detail, a lot of detail with this, but I'm going to stick to kind of the main topics right here. Comparable market analysis. Once you do pick that house and you say, this is the one I want, I'm going to look up that area and get all the numbers and figures for the area. Probably I'm going to go back 6 months. I'm going to look at what's sold, or the price is sold at, the condition of the house, to make sure that the house you're looking at and you want is a good fit as far as market wise. So that's definitely one of the things I'm gonna do once you say, hey, this is the house we want. Next slide. And this is the key components that I was talking about that break down your offer, contingencies, the price. You may not want to offer full price. It's just everything just depends. Everything depends. Everything's negotiable and everything depends. We may go under 10,000 of what that sales price is. Never know. It just depends. And all cases are different. Next slide. Again, everything on that offer when we submit it over is negotiable, from who pays for the termite inspection, your inspections, financial contingencies, earnest money. Everything on it is negotiable. So that's definitely something we'll go back and forth over as far as with the seller. I never had one offer go in and just accept it. It's always something, maybe something small, maybe something big, but that's definitely what I'm here for. And every time something comes back as far as a change, that's when myself and the clients, we sit down, go over everything, see how you feel about it, say yay or nay, and then we send it back over. So it's definitely a process, a back and forth process on both sides. Next slide. Home inspections and appraisals. Yes. Next slide. Of course, I do have a list of trusted professionals that I work with. You don't have to use them, but I definitely say I do already have a list of appraisers, home inspections team. Let's talk about home inspections real quick. I do suggest that you are there. This home inspection, that inspectors going to come in, as you see in the pictures, they're going to go through the house from top to bottom. They're going to inspect, look for things that need to be replaced or repaired. It usually takes about, depending on the size of the house, about 2 hours. Price is also depending on the size of the house. It can go from $300 to probably over $700-800. It just depends on, again, size of the house. Some houses have crawl spaces, some don't. But the key thing is to be there during this inspection. This is your time to ask questions. You can walk through with him. I definitely suggest that walk through with him, ask questions, and get an explanation right there on hand. And when he's done that inspection, he's going to send us a full report. And that's when we sit down, we'll look at the full report, and we'll see what he suggests as far as what needs to be replaced or repaired. And let's say he identified 20 things that need to be replaced or repaired. And if you want to send that whole list of 20 things that need to be replaced or repaired over to the seller, that's what we'll do. We'll negotiate those repairs. Some things you may be good with, you may not want to send over. And let's say the seller is all good. They'll fix everything. Then we keep it moving, which is rare. But again, that's a negotiating point that go back and forth a little bit until both sides are comfortable. And then you sign a paper saying, hey, we are comfortable with this. Buyers, sellers, we are comfortable with this. And then we're able to move forward. Everything we do throughout the process, both the seller and the buyer, both sides have to agree to it before moving forward. So that's definitely one of the key points. Next slide. Same thing as far as appraisal. Appraiser, they come out and they will do their version of a CMA, which is a comparative market analysis. They're going to look at the homes in the area. They're going to have an evaluation report. They're going to see what's sold in the last 6 months. They're going to look at everything and make sure the house that you're purchasing is worth the money. Next slide. Finalizing the mortgage process. Next slide. Jennifer, you want to hit on this one?
Yeah, absolutely. So completing loan application and documentation. So once we have that introduction, the phone call or the face-to-face or the video chat, you'll go ahead and do the application. It takes 10 to 15 minutes. You'll upload your documents after you have completed the application. And then that's when I will take my time to review your credit, review your income, review all of the documents that you've submitted. I may even call you back with a few questions depending on what I'm seeing. And then once that's completed, then you would pretty much get issued a pre-approval. If for some reason, let's say your credit is not where it needs to be, or you don't have any money saved up, or maybe your debt to income ratio is a little higher than expected, those are things that we'll be able to talk about. We can get you over to a credit specialist who can help you with credit if credit happens to be an issue for you. I've helped people, say, hey, we're going to have to get a co-borrower. Your debt to income ratio is too high. We need to see if there's a co-borrower, or maybe you might need to start looking at different careers, because I know sometimes the careers that you could be in is just not going to give you what you need in order to qualify. And that's just the real of it. That's just the realness of it. And sometimes we need to shift or pivot and do something different. I'm here to help you however much I can help you. I've helped people find different jobs or get into different careers just because what they were doing was never going to get them to that goal of getting that golden ticket and buying that house. So however you need assistance and help, know that you have a team of people right here that is here for you every step of the way. And so that's pretty much it in a nutshell. Once we give you that pre-approval and you go shopping and looking for your home, and you find one that you like and you get under contract and the contract is ratified, Damon will send that over to me. I'll do what I need to do with that. As far as in-house, I have some assistants. You'll be speaking to people that's on my team, my assistant, my processor, my underwriter. They'll be kind of getting things together for you. And we can be closing in 30 to 45 days. I mean, I've done some 15-day closes as well. It just depends on, all of the things that we have going on as far as your financial information. Somebody asked, can a co-borrower be a co-owner? Give me a little bit information of what you mean by that. Can a co-borrower be a co-owner? Tell me what you mean when you said that.
I think they mean co-owner.
Oh, co-owner. Okay. Can a co-borrower? So a co-borrower is someone that does not have to live in the house with you, but they're willing to get on the mortgage or on the loan with you for you to qualify. Two reasons why you would need a co-borrower is if basically your debt to income ratio is too high. So, and you don't have two ways to lower your debt to income ratio. Either you are increasing income or you're paying down debt. So you would need that co-borrower to be able to add a little bit more income so that we can lower your debt to income ratio. So that's what a co-borrower is. And then the question was, what was the question? Can a co-borrower be also a co-owner? Yes, because they would be on that deed of your house. But keep in mind, if you need a co-borrower, you don't have to have a co-borrower for 30 years. Sometimes it's just like getting a job. You don't really want this job, but you're going to take this entry-level job because you're just trying to do what? Put your foot in the door, right? So same thing with home ownership. You don't really want anybody on your loan. You want to do it yourself, but unfortunately, it doesn't work with you doing it yourself. You need somebody to help you. And if you have someone in your family or a close friend that's willing to do that, hey, write a contract together. Hey, I only need you on this loan for a year, because once a year is up, I'm going to work on my credit and get my credit increased. I'm going to get a better job, or I'm going to get a raise, and we can refinance that co-owner off. So having a co-owner is not a horrible thing. They don't have to be on the loan forever and a day. It just may be something you need to do on the front, just to be able to do what you need to do.
Got one more slide for you too, Jennifer. Underwriting, which is the next one.
Okay, clearing underwriting conditions. So like I said earlier, the underwriter is the person that makes the decision whether they're going to give you the money, give you the loan to be able to purchase the property that you're trying to purchase. They're the ones that are going to look at all the documentation that we have collected from you up front, but they also have systems in place on the back end where they can see if you have property, or they can see if there was a charge off or a collection or something that maybe I can't see, because what I'm looking at is what you sent me. You know what I mean? But there's some things that I can't see because I'm seeing things. I'm seeing what you've given me. But underwriters have the ability to go beyond what you send me. So I always tell people, please be truthful and please be honest when we're talking. If you know, when you're talking to me, there should never be an opportunity in your mind, or you should never be in a place where you feel like, oh no, I can't tell her that because I don't want to look bad, or I'm a little embarrassed. I tell people, take that off the table, because even if I'm not able to see it up front, the underwriter is going to see it. And I like for you to tell me up front, so that if we need to come up with some kind of game plan or workaround around it, we can do that up front, instead of you already being under contract and we got 30 days to close this thing, and all of a sudden something big happens, you know, like you're not actually married and you said you're married, or, you know, just all kinds of stuff that I've seen. Things can pop up. So underwriters are really, they're like, consider it like the judge. I'm your lawyer. I'm helping you to prove to the judge, which is the underwriter, that you are worthy to receive these funds to buy this house. That's the easiest way to put it. So they make the actual decision as far as if we can actually loan you the money to buy the house. They're going to assess risk. They're going to verify your employment. They're going to verify the assets. They're going to verify the appraisal. The appraisal is definitely an important part of the home ownership. I've seen people that have all of their stuff together, but because the appraisal didn't come back in the right value, you couldn't buy that house. Doesn't mean you don't qualify. It just means that house that you're trying to buy don't qualify. So the house got to qualify too, just like you, in order to make it all work. One of the biggest things is communication. Me and Damon are great communicators. Everybody that we work with, including you guys, are great communicators. That's what people like to see. Like I said, if there is something going on, be open and honest to let us know. I like to know stuff up front. That way I can help you navigate it, instead of me finding out later and we close it in 7 days and boom, this just big thing comes out. And I'm like, well, did you know such and such and such? Yeah. Well, why didn't you tell me? So it just to kind of make sure that things are smooth. It's best to be honest and communicate those things so that you can prevent delays. And that's pretty much it.
Next slide. Review and closing documents. Next slide. So closing disclosure. This is what you get. I'm gonna go skip to the bottom real quick. The regulatory timeline requires the receiving disclosure at least 3 days prior to closing review. Sometimes it happens, sometimes it doesn't happen, but you will get a closing disclosure 3 days before closing. Once you get this document, I sit down with you and I go through everything. And what it is a detailed, itemized list of who paid for what. On the left side, you will have all the details. Then you have 2 columns. One column will say buyer costs, other one will say seller costs. And it says who paid for what. And it just goes all the way down. So again, this is a detailed, itemized list of the entire transaction. And you have, by law, legally, you're supposed to get this 3 days prior to your closing. It also projects your monthly payments, your closing costs and escrow, and summary term loans. Everything is on there. So it's a full disclosure of everything that we talked about during the transaction that you went through, who paid for what. So this is definitely one of the most important documents you get towards the end. Next slide. Pre-closing, closing costs, range of closing costs, all of that, again, will be on the disclosure statement. Importance of budgeting, make sure you're able to, let's say if in that contract that we negotiated probably 30 days ago that you said you're going to put down earnest money, $5,000 earnest money, we have to make sure that went into escrow and that's still in escrow. If you say a down payment, was negotiated. Make sure you're budgeting and saving up to have all this for closing. Assistance program, buyer assistance program, some of the things that Jennifer talked about earlier, first time home buyers. There are a lot of different programs, state funded programs to help out for first time home buyers, and assistance and down payment programs also. So this is where all that comes into effect. Again, that closing document will list everything. It has everything on there. Next slide. We're almost there, closing and moving in. We're getting close to them keys. Attending the meeting and signing papers. I always tell clients, once we get to that day, you're going to be signing a lot of paperwork. You're going to be signing a lot of paperwork. But again, it's once that attorney slides you them keys, that's the best feeling in the world. So you'll be signing legal documents. You make sure you have your identification. I'm definitely remind you of that. You'll also be sending in your payments. You'll get a wire fraud paperwork to make sure you're sending all your payments to the right person, to the right attorneys and everything like that. Because, you know, scams and everything, how it is today. But that paperwork is secure and encrypted, those emails that they will send you. But I always say, even though when you get that stuff, still call and make sure, hey, did you just send me this email? Just to make sure. Then we have the final transfer of ownership and duration and preparation. The attorneys, everything will be prepared by the attorneys. Attorneys are a neutral party. All they're there to make sure is both parties execute the contract, pretty much. And then, like I said, at the end of the day, that's when you get them keys. That's when you are on that, finally a homeowner, and everything goes through. Next slide. I think that was receiving the property keys, transferring utilities. Maybe usually sometimes it's 1 or 2 days. You still have all the utilities on. It may not be off yet, but again, a week or two out, I will let you know what day to go ahead and start calling and letting the utilities know on this date we can transfer. But it usually is like a grace period of 1 or 2 days for us that we tell the sellers, hey, leave it on for 1 or 2 days, give the new homeowner a chance to call and get everything transferred over. And I do have a checklist for just about everything. So that is one of the main things. Set up water, gas, forward your mail, everything is considered. Next slide. Planning your move, effective moving preparation. Again, I would say once we get clear to close from the underwriter and from Jennifer, that's when you want to go ahead and start looking at making all the preparations for your move, because that clear to close is your final stamp of approval that everything on the finance side is good. Then I will also check with the attorneys, make sure the attorneys are good, to make sure we hit that mark and we hit that date, because even on both sides of the move, the seller is moving and you're moving in. So we have to make sure that date is kept. And that's one of the benefits of being having an organized move, trying to keep that date. Next slide. In conclusion, we talked about financial preparation. We identified the needs as far as real estate, working with professionals, loan officers, realtors, and we navigated the entire process from start to finish as far as home ownership. Good information. I appreciate everybody showing up and the questions. Jennifer, you got anything? Any final words?
I'm excited to be here. I'm happy to help anyone that is ready to get started. If you're not even sure if you're ready, we can, look at your information, look at your financials and kind of see if you're ready. If you're not, I can walk you through it. I'll hold your hand as much as you're willing to allow me to hold your hand. And I can give you my information too for those who want to reach out to me one-on-one as well.
We are definitely going to post information in the description, all Jennifer's information and email contact, my information and email contact, and also definitely the Next Gen team. Check out their website. Well, check out the YouTube channel. It's great information on there. Definitely like, share, and subscribe for the Next Gen family. If anybody has any last questions, we are going to do this probably for the next couple of months on a monthly basis, because we definitely want to put the information out, get the information out as much as possible for our buyers. The next scheduled one is April the 23rd, which we'll be talking with sellers. But if you're a buyer and you still want to jump on, absolutely. That way you can see it from both sides. But the next one will be try to focus on sellers. And yes, Dana, you got anything?
No, this is valuable information. Thank you, Jennifer. Wealth of knowledge. And of course, Damon is our real estate extraordinaire. If you guys want to know, these are the people that have the answers to your questions. And for those who were not able to be on the live stream, just know that you are free to leave your questions in the comment section after this broadcast, and either Jennifer and or Damon will reach out to you. Again, their information will be in the description. So definitely make sure that you share this information, because knowledge is power. It may be your first time buying a home, or like me, I hadn't bought a home in 20 years. Things change. So even if this is not your first time, it's always good to have a refresher. So thank you again, Jennifer and Damon, for this 2026 edition. So You Want to Buy a House. Turn it back over to you, sir.
That's all I have here. Again, appreciate everybody coming out. Appreciate your questions. And we are just here to put the information out. Whatever you need to know, we got you. Thank you.
Thank you, and good night, everyone.